Well, today's Thursday, so you know what that means. It's time for 3-Minute Thursday. I'm Terry Sawchuk from Sawchuk Wealth. I'm going to share with you basically an hour's worth of data in less than 3 minutes. So let's just get right into this. Yesterday, the Federal Reserve met. They announced they were not going to raise interest rates, nor were they going to cut interest rates. But what was more important is that the language around this meeting was very dovish, meaning that they're moving to more of an accommodative policy as opposed to a hawkish or tightening policy. Why this is really important is because the markets reacted, started to go quite a bit higher, and that kind of takes us to this where I'm at in the presentation, which is currently fundamentals don't matter. Price to earnings ratio, price to sales ratio, corporate earnings, none of that matters. All that matters is that the flows are positive. Okay, so what I mean by that is that between now and the middle of January, there's an estimated roughly anywhere from 2 to 10, and it's probably closer to $10 trillion of forced buying called reinvestment or recollateralization. Basically, it's just a whole bunch of options buying that is probably going to push the equity markets higher. And it has nothing to do with how good or bad earnings are or anything else. So the market's likely to push higher. In fact, it could actually get to all-time highs between now and the middle of January. But in my opinion, it's going to be very short-lived. Once we get to the middle of January, the flows stop, and it really opens up a lot of downside risk. There's also a pain trade, and this is what's been pushing the markets higher. There's been a lot of hedge funds that have been short specific stocks. And even these garbage stocks, which probably shouldn't be going up, have been going up. And it's been forcing these hedge fund managers to actually buy the stocks that they're trying to bet against. And so as a result, it's pushing those stocks higher. So this has really been a broad-based rally. But when you look at every single metric, the market is substantially overvalued, okay, way overvalued. Janet Yellen is literally doing everything she can to prevent Donald Trump from getting elected. Biden's poll numbers are absolutely in the tank. They're the worst they've ever been. So she's trying to do her part to at least juice the economy a little bit, get his poll numbers up heading into the election next year. And that's not going to change, by the way, but she might not be able to do a whole lot. Populism is creating a long-term issue. It's going to create geopolitical tensions, global macro tensions. And so where I'm at right now, it's very straightforward. We're not really going to try to participate in this 30-day rally. Where we think we can make money, and maybe almost as much money as in the stock market, is in gold and U.S. treasuries, especially short-term treasuries. We think that the risk right there makes way more sense. The upside could be equal to or possibly even greater than the equity markets over that 30-day period, but the downside considerably less. So there's your 3-Minute Thursday. Appreciate the time. We'll see you next